And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today we're going to talk about the Main Street Lending Program. The Main Street Lending Program. Now, I got to tell you, friends, I have not read up on this program. I remember whenever it came out, I saw it and it was like, I can't deal with another type of a stimulus or another type of loan program this year. Man, it's been a year for the record books. We look at what happened with the CARES Act, and we had the PPP, which, we did 5, 6, 7 different podcasts and YouTube videos and Facebook Live events on how that particularly can affect us business owners. And then we dove into the EIDL loan. That's the economic injury disaster loan that the SBA was administering. And in the midst of all that, we had the Main Street Lending Program. And as it came out, I just couldn't deal with it. And I've kind of kept myself distant from this until recently. Recently, a trusted colleague of ours, a trusted industry expert, reached out and he said, "Hey, Justin, I know this. I am the master." Now, he didn't say that, but he said, "I know this. I know this program." And he gave me some really interesting insight into this. So I've asked our guest today, Mr. Don Pippin, to come on to the podcast here with Financially Simple and walk through a financially simple view at this Main Street Lending Program. How are you doing today, Don?
I'm great. I'm blessed.
I'm with you, brother. I'm with you. So before we dive into the program, I need to ask you about a couple of these designations that you have with the industry that you work in. So I see you're a certified business intermediary. What does that mean?
Through our industry association, the IBBA, there is a certification that business brokers can, take the coursework and take and pass a test. And it's really just a way to have a much broader depth of knowledge about valuing and bringing businesses to market.
Now, I also notice that you're a mergers and acquisition, we say M&A, mergers and acquisition master intermediary. So is that the same type of structure?
It's similar. There's a sister organization to the International Business Brokers Association called the M&A Source. And so for a lot of business brokers across the country, and I know you know a lot about this on the podcast that you've had in the past, that most CBIs are particularly focused on Main Street, whereas the M&A Source and the M&A designation is more focused on the lower middle market. So that's the difference in the two. And they really are separate approaches to how you deal and bring a business to market and how you find the buyer.
Yeah, we actually spent a lot of time in the first 2 seasons of the podcast, friends. If you want to go back and listen to those episodes, I actually speak in detail about a business broker and a mergers and acquisitions advisor. And Don is an expert in these areas. So Don, before we dive into the Main Street Lending Program, tell me a little bit about the types of clients that you have the honor and privilege to serve every day and how you work with them.
Yeah, no, I absolutely love the work that I do. I'm entrepreneurial all my life and had started from startup and sold businesses and bought businesses. And so about 6 years ago, I had the opportunity to move in, buy a brokerage in the local market. And I certainly have learned a lot. I thought I was an expert at the beginning, but, this teaches you a lot as you go. But I've absolutely enjoy it. And so day to day, we're working with predominantly, most of our practice is what you would call Main Street. 60% plus of business owners are baby boomers. And, the youngest are now in the mid 50s, the oldest in the mid 70s. And so we are at a time, especially, in the COVID related time, where people are really thinking about their business. They start a lot of businesses, but they never sell them. So they really are needing someone, a group of professionals that can help them bring their private, closely held small business to market, to expose it to the market, to find the best buyer at the best price possible.
One of the questions that I'm going to ask you later on, I want to go and throw this in your head, is why do businesses not sell? So I want to come back to that to the end of this, but you mentioned the term Main Street, and I want to kind of use that as a segue into the Main Street Lending Program. So for our listeners, let's pretend we're flying on an airplane. We're starting high level, and let's bring it down to the technical level on the details that they really need to know, at least enough to pique our interest to know, should we look at this or should we not? So let's begin with the high level. What can you tell me at this highest level about the Main Street Lending Program?
Well, as you had said, this for the PPP and the EIDL were through the Small Business Administration. In the CARES Act on March the 29th, they also did introduce the Main Street Lending Program, but this is funded through the Federal Reserve with a participation with the Treasury. And so, for most small businesses that have been impacted by COVID, this program, it appears to me, is specifically designed for companies that did very well in leading up to pre-COVID. So in 2019, for most companies, they had a banner year. It was an amazing year with a lot of expectation that 2020 would even surpass that. But due to the COVID and the shutdown, a lot of companies have found themselves just in cash flow situations. They haven't been able to open or otherwise. So this was just to provide liquidity, a loan vehicle for companies to avail themselves to if it made sense for them.
Okay, so let's deal with a little bit of technical here. I know on the PPP loan that was a forgivable loan for the most part, as long as you stayed toward the guidelines that was in the CARES Act.
Right.
And then the EIDL loan, the economic injury disaster loan, that was a loan with a relatively low interest rate, but it was spread out over 30 years, so non-forgivable. How is the Main Street lending loan position? Is it a forgivable loan or a true loan that's not forgiven?
It is a true loan and it's not forgiven.
Okay.
There is no facility for it to be, meet some kind of metric where it later would be forgiven. It's straight up from the beginning, more like a conventional loan that would not be forgiven.
So on the Main Street loan, if it's issued by the Treasury Department, if I'm correct on this, I think I remember hearing Stephen Munich talk about this whenever I was in one of the meetings that he was speaking on. So it's issued by the Treasury Department. It is for Main Street, but if I remember right, there's actually like 3 or 4 different flavors of this loan. I say flavors because kind of like ice cream. I'm thinking about ice cream right now, Don. I don't know, but what's your favorite ice cream, by the way?
I try to stay away, but you can't beat Bluebell.
Bluebell. Do you have a particular flavor of Bluebell ice cream?
Vanilla is the bomb.
Vanilla, the bomb. See, I had to have mint chocolate chip. That's my thing. But in the lending program, you actually have several flavors. So I think in this program, there's 3 or 4 different types of programs underneath the Main Street. Is that right?
There is. And just to back up for just a second, so the application process is not through the Treasury. It is currently, there's about 585 participating banks. Okay. A lot of community banks are associated with that. I'm personally looking at a loan, potentially more than one, and talking currently with a local type community bank. And it really is their guidelines. So, once you've contacted a local bank that's a part of this program, they will give you the full details on what they need, whether it's 4 years of tax returns, income statement, personal balance sheet, just the details that they're going to be looking for. But in the 3 flavors of it, one is called the new program or the new loan facility. And it is between $250,000 is the minimum loan amount, okay, and $35 million. And that one is really designated for if you really are not looking to pay off existing debt, you had some cash flow issues and you just need a new loan to bring into the business to be able to support it, as we come out of hopefully this pandemic fairly soon, then the new program is the one to go with for that. A couple of the features that all 3 of these have is that the principal is deferred for the first 2 years. And interest is deferred on the first year. And the way it's set up, this loan is a 5-year term, as you said, not forgivable. And so the first year, no principal, no interest. The second year would be interest only, and I'll talk about the interest in just a second. And then there's a 15% loan amount reduction of the principal at the end of the 3rd year. And again, at the end of the 4th year. So that would be 30%. And then 70%, so think of it like a balloon payment of 70% at the end of the 5th year.
So in that scenario, I got 2 questions. I have 2 questions for you. The first one is it a front-loaded interest loan where you're paying all the interest on the front side to where after the year number 2, you're only paying principal only? Is that correct? Or is it?
It's my understanding that it's, it's distributed across the loan.
Okay. All right. And then second thing, I'm assuming because they're ballooning it out in 5 years, that at that particular point, if it's not paid for, that you're looking to do a refi, probably at the same lending institution who gave you the Main Street loan.
That's correct. And for a lot of these same institutions, they also do SBA lending. So you could convert it to a SBA loan at that time.
Yeah, so I think one of the links that you gave me that we're going to put inside the show notes. And friends, there's a lot of links on this information. This is a pretty technical loan. It's just about as technical as the PPP or the EIDL. So Don's put together a whole bunch of lists that we're links. I'm sorry, that we're going to put in the show notes. So make sure you check out the financiallysimple.com, the blog that correlates with this podcast. Or if you're listening to it on Audible, Stitcher, Spotify, wherever it is, iHeartRadio, click in the show notes below, and you'll be able to look at the links to these particular details. So as we're looking at this Main Street, what you call the new program, I think that was the first flavor.
That's right.
What's the second flavor?
The second one is called Priority Loan Facility. It is designed for the company that has debt going into COVID, and they would like to either pay off that debt or expand it. So from that priority, the only thing that changes, it's 250,000 to 50 million instead of 35 on the new. But it has the same 5-year terms, the same interest and principal reductions. The interest rate on all three of these is basically it's 90-day LIBOR, which currently is about 0.23 to 0.27, somewhere in there, with 3% that the bank would charge. So about 3.5 or less, 3.5% or less on that.
None of us are immune to the stresses that come with owning a business. At some point, we've all considered hanging it up and selling. But is your business prepared for a sale? Heritage Business Advisors can help you maximize your business's value through targeted value growth and exit planning. To learn more, visit heritagebusinessadvisors.com.
For a 90-day time period, you mentioned 90 days. Does the loan balloon up in the interest rate, or does it stay constant this 5-year term?
No, the rate is consistent. It's a consistent rate loan, but the part that the Treasury keys on is that LIBOR 90-day rate. So as that changes, depending on when you apply and when your loan is funded, that could change a little bit, but not very much. I think it's been pretty steady.
That's actually a lower rate currently than the EIDL loan. The EIDL loan was at 3.75. So this is actually a lower rate than the EIDL loan. So I've even heard, Don, individuals who receive the EIDL and they're not using it, they're going to pay it back. And this would be something that, if they were, instead of paying over a 30-year time period, they want to pay it over a 5-year time period, like a lot of business owners want to do. This would be a better program than even the EIDL position.
It could be. The only thing is, as well, with this is that they look at the existing debt, including PPP, which is for most people under 150, potentially to be forgiven 100%. But the EIDL loan would be deducted. So the basis, the borrowing capacity of a business owner. So just to be clear, you had to have been a business owner in 2019, and it's based on a multiple of your EBITDA for that business for 2019. But so for the new program, it's 4 times EBITDA. And for the priority program, it's 6 times EBITDA. But so that EIDL loan or other debt that you wanted to pay off will be calculated and subtracted from the EBITDA before you do the calculation on it.
Understand. So let me just recap quickly on these first two before we go to the third one. The first one you called the Main Street New Program, and that was between $250,000 to $35 million. And it was basically for those businesses that needed additional working capital that wasn't trying to refinance any debt. Did I get that right?
That's correct.
And then the Main Street Priority Program was the second one you said, and it's roughly the same, 250 now to 50 million. So it's a little bit bigger business, and it's designed for those who want to refinance debt. Does that sound right?
Yeah.
Okay. What's the third flavor here?
It's called the Expanded Loan Facility, and it starts at 10 million and goes to 300 million. So not really a Main Street type day-to-day entrepreneurial, owned, run type business. I think that that's more on the, the larger side. And the difference in that is if someone already had a loan and needed to add another tranche or another piece to that, then the expanded would be the one that could be available for that.
So we had the three different flavors. Now I read the document, there's four, and I think the fourth one was for nonprofits.
It
Am I
is.
correct on that?
Yes, that's correct. There's actually two different programs for nonprofit.
So you mentioned with these four different programs that it's a factor of your EBITDA, and we actually, for friends, go back and listen to the podcast. We go in detail on how EBITDA is calculated. If you've never heard that term, I challenge you to go back and listen to the episodes. Just search EBITDA on Financially Simple. So in these loans, it's a factor of EBITDA. It is going to be adjusted by your PPP or the idle loans on these particular positions. Now, is that just with the new program, or is it with the priority and the expanded as well?
It's with all three.
So with all three. Okay.
And the debt is also not just necessarily for the PPP and the idle, but it would be for existing debt as well.
So you mentioned that you had to be in business prior, and at least in 2019. This is not for those individuals who went out and started this year. And candidly, Don, I have a couple of clients who wanted to start business this year, and everything was looking really up and up. And
right.
Man, they got hit. And now we've worked with their institutions to actually get some forbearance on some of that lending.
Right.
So these are for business owners who started last year, who were just moving and shaking, rolling with it. I got to ask: are there any rules on the monies on what you can use it for and what you cannot use it for?
Yeah, I mean, it's there. The guidance is, so like, for example, as a business broker, my interest in it was to help business owners who are looking to grow their business during this time. They may not be ready to sell today, but they would like to buy a competitor, or they would like to continue to grow through acquisition or assets or otherwise to enhance their business. So the guidance is not so much on, they're not regulating what you can do with the money as much, because, like, for example, if a business owner were to take, say, a new loan facility and they wanted to acquire a competitor, they don't even look at the financials of the business that you were looking to acquire. The loan approval is strictly based on, you as that business owner and your financials for the examination period, which is in this case, through 2019.
Is there, are we allowed to pay this loan off early?
Yes, there is, with no prepayments.
Yeah. And then I'm assuming it's basically small businesses that under 500 employees or so is eligible for this, or?
Well, actually it's 15,000 employees. So it's, so it expands to a particular level, but yeah, I mean, I think a lot of Main Street day-to-day entrepreneurial owned small businesses would take advantage of it.
So one of the questions that I often have whenever I look at this type of lending is, what is the best use? And so as I'm looking at it with business owners, Don, that have, they were cranking it out. They maybe don't want to sell for 2, 3, 4, 5 years. Maybe it's 10 years. I mean, I talk about my own self. I want to have our company totally positioned to sell within a 10-year period of time for a certain number. So I've got a 10-year mindset in my mind. You've heard me talk about that.
Yep.
So we have other business owners that are out there that may not have a 10-year time frame, but they may only have a 5-year time frame. And I'm looking at this saying, it's not a bad move to be able to perhaps go out and buy competition and buy another business and absorb it into your company. It might be not a bad idea to use some of this lending to go and perhaps buy some strategic alliances. I was talking to a auto repair company that all they do is engine repair, and they were losing a lot of capital on tire and brake. And it's like, guys, why don't we buy a tire and brake shop, and then let's buy an oil changing shop, and let's build out a whole empire here together. Could you utilize this type of lending for a strategic play in your business to to grow the business so that it's more attractive to sellers in the same 5-year time frame?
Yeah, absolutely. And that's what really caught my attention on the program to begin with. It's because us working day to day with business owners who in the same way are looking to exit their business at a future point, they're always looking on how can I add, value? How can I, do something in the business today, let a little time go by and I can capitalize on that. So, that is exactly one of the benefits of the program is that they don't really examine too much. So if you want to buy an alignment machine or a tire machine or whatever it is within that business, the reference that example you gave, then there is no limit on that. They're not dictating to you exactly what you can do with the money.
So let's use that as a segue. So before I do that, friends, we've covered a lot of information. Our team is going to place this into a written format. We're going to put all the links that Don has provided to us again inside the blog format, inside the show notes. I want you to check it out there. But Don, let's segue from what you just described as an expert, and I don't think I've ever had a business broker on the podcast in almost 3 years. So
Well,
I
I'm
think
glad
you're the
that
first. Yeah. So, I'm often talking about as the financial guy, the person who's trying to teach people how to grow their business and how to grow their net worth. I often state that one of the concerns I have is business owners are not prepared to sell their business. Let me ask you the question I've kind of tossed out there earlier. What, in your opinion, as the person in the trenches who are looking these individuals in the eyes saying, hey, your business isn't ready or your business is ready, what is the number one cause that makes a business not ready to sell?
Probably at the heart or the root of it is the owner-centric business that the entrepreneur, and it's easy to do. It's the path of least resistance for an entrepreneur to get started. They build a team of support around them, but they never really get to the next level where they're able to have a management team and that their role over time becomes diminished. For a lot of entrepreneurs, they get started mostly on a shoestring budget. They work hard, they end up successful, but they just don't, move to that next level. So when you really look at the concept of trying to sell it, bring it to market and sell it to a third party that's unaffiliated or not related, if every answer to every question about business leads back to the owner, then it's really a pretty difficult task to replace that role 100%, a manager. So in contrast that, when we are able to advertise you have a manager run business, then it's a completely different story because that manager, is paid a salary. In that case, the owner, the new buyer may come in and capture that salary for themselves and choose to run it themselves. But, that owner, because they've been there sometimes 30, 40 years, are very ingrained. They've got reputation, they've got relationships, they've got a lot of other community ties. And it's daunting for a lot of times first-time buyer to come in and replace that person in that role, that entrepreneurial owner role in that business.
I read Michael Gerber's E-Myth yearly. I love the book. Love the book.
I love it.
Inside his book, he talks about that no one wants to buy a job. And it sounds like that business that you just described is just a glorified job, not a true business that can operate without the owner there. Am I correct?
Right.
Yeah.
I mean, I don't know how practical it is, but just a sobering thought, which is if you called your business and whoever answered the phone, it doesn't really matter who answered, just say, hey, Don, something has come up, unfortunately, and I'm not going to be able to be there for 6 months. I'll call you when I get back. For most small businesses, that is the ultimate nightmare scenario, because what's going to happen in 6 months? What's going to happen tomorrow? And so for a lot of entrepreneurs, if you're, especially long-term entrepreneurs, is how do you begin to think about your business in a different way? And what's your role? What's your relationship in that business? And it may cost you some profits in the short term, but it absolutely can expand the business, your income in the long term. And it's not for everybody, but the question was challenges faced to sell, a small business, and that's one of the biggest ones for sure.
So my guest today has been Don Pippin. He is the president at the Sunbelt Network in Lafayette, Louisiana. And we'll have a link to his website in the show notes as well. You're hearing Don, interestingly enough, talk about what I often speak toward with our clients. Hey, look, we're here today. We know where we're going. Whenever we get the client ready to sell, someone like Don actually comes and helps them through that process. And I often speak about the throes that I hear and the pain, friends, that I hear business owners. And here we have first and foremost someone who's in the trenches, on the battle line right now, who's trying to show business owners how to do this. So I want you to heed his words. This is words of wisdom. This is from the front line. So Don, man, I appreciate you being here on the podcast today. We're going to put the website beneath. By any chance, are you on social media where people can connect with you?
Yeah, I'm on LinkedIn,
Okay.
Don Pippin on Sunbelt Network.
Great. So we'll put a link to your LinkedIn profile as well. Hey, Don, as we sign off, any last parting words? You've got a group of business owners here I know who are hanging on to every bated breath of you. What last words of wisdom would you share if we sign off?
I think just take a look at the Main Street Lending Program. It could be, it's not for everybody, but it is simpler than the SBA. It's less expensive, in terms of interest rate and fees. Whereas SBA is typically about 3% of the loan amount. This is about 1.5% to 2%. So it could be, an advantage. And, for entrepreneurs, it's, this COVID has shot us, all somewhat. And I'm just believing in a brighter day, and we're going to get back to 19, levels and just kind of put an X on 20 and move on.
Absolutely. Well, Don, I appreciate you being here on the show today,
My
friends.
pleasure. Thank you.
Friends, as you've heard today, we've got a lot of information coming. We have other experts coming up in the next few weeks. We're preparing for me to actually try to do what Don mentioned. I'm going to leave the office for 3 weeks, and we're going to see where the companies are relying on Justin. So I'm the owner of the company. We're going to try it. We're going to see, we're stress testing our own company. So it's interesting Don mentioned that. So I'm trying it myself. I'll let you know how it goes whenever I return here. We have other experts coming on the show here the next couple of weeks. Can't wait for you to hear them. Look, I realize, I get it. As Don just mentioned, life is hard. COVID has kicked several business owners square in the teeth. I realize that life is hard, but man, life is good. We live in the United States of America. We are a blessed people. We have food on the table. We might actually have some pizza tonight. So we are a blessed people. Life is good, and life can be frustrating, but look, money doesn't have to be. Hey, let's continue to make our lives at least financially simple. Y'all go out and make it a great day. This tip is for informational purposes only. Please speak with a competent financial advisor regarding your specific needs. Justin Goodbread is a registered investment advisor with Heritage Investors. Visit heritageinvestor.com, financiallysimple.com for additional information.